prices. They've been acting very positively.
In the short term.
In the short term,
yeah.
yes. You have to zoom out the charts, but just over the past 24 hours, we've seen rallies in those stocks. So I'm curious about how you approach this as an investor. So there's so much short-term noise here. Are you tactical in this environment, or do you just sort of cover your eyes and
Well, I think the big question out there is the tariff frenzy, is it ultimately inflationary down the road? And I, again, would kind of de-emphasize what one-month CPI print looks like, and then I would instead emphasize what is the leadership messaging of the market, and go back to second half 2021 into 2022 when we were kind of in the throes of that beginning first stage of inflation. Your leadership was very pro-inflationary. It was energy stocks outperforming. It was material stocks outperforming. That is not the market's messaging here. Aside from a bounce in materials today, they have not been your leadership. The energy stocks have not been your leadership. So I don't buy this idea that the market is dead set on all this tariff implementation ultimately being inflationary. I think, if anything, when you look at bond yields over the last number of weeks from 480 back to roughly 430 today, that seems like the market is more worried about the growth side of the equation than the inflation side.
I want to ask your take on credit, and I got a message from a viewer who says he thinks it's underappreciated in the market how much JGB Treasury spreads or Bund Treasury spreads have compressed over the past month. We've seen massive movement there. What do you think about Treasuries? I mean, it was even interesting to see today when the inflation number came out, yields first went down and then all came up across the curve.
Well, let's put this first in some short-term context. We're only 6 weeks removed from 10-year yields being about 480 when everyone was certain they were on their way to 550, right? And what happened lower. If you look at the last 2 years, we're essentially in the middle of the range. The average 10-year yield over the last 2 years is about 420, not too different from where we are today. The correct Treasury call for the last 2 years has been no call. It's been an extremely frustrating range. But Matt, I think you make really important observations about what's going on globally. German 10s look different. They look like they want to go higher. Certainly Japanese 10s have been moving higher the entire time. And
highest level in a decade.
And you see it with yen. And I would just emphasize to the viewers, think back to when tech's relative performance versus the S&P peaked last July. What else peaked last July? Dollar yen. So to think that strengthening of the yen is not disrupting or changing how money moves around the world, I think would be silly. And I think the biggest impact of it has been seen with tech's underperformance since.
Chris, we thank you so much for joining us here on set. I'm glad you brought up that yen point. It's been an important and underappreciated
I'm glad that people who are watching write in, shoot me a message.
They have the
talk
sound
to us.
on. That's great.
Chris Verone of Strategas Research. Thank you so much. Of course, Strategas is a Baird company. I also want to, guys, point out a point that Chris was making here about the leadership, because on the flip side, you have the negatives, and consumer discretionary has lagged the market so meaningfully relative to what you're seeing elsewhere, down more than 12%. I've also got to say, the great Stanley Druckenmiller came into this year short this sector, according to his pick a ticker tracker, which is a game that is tracked by Robin. You see what I did there?
Yes.
We've
been talking about this all morning, this pick a ticker. It's a contest that Bloomberg does, together with Robinhood?
Yes, exactly. And you can look at what the great investors are doing. That includes Bill Ackman, who's leading, and Druck is high up as well, partially because of that consumer discretionary short.
We will talk more about that at 10:10 a.m. with Carson Block. But I will say, if he was short consumer discretionary, he's just short Amazon and Tesla. Amazon is 38% of the consumer discretionary index. Tesla is 14%. Then you start to get actual.
It's good to be short those
I know,
two stocks.
but I'm just saying it sort of distorts the macro narrative.
It's a messy read, to your point, that index.
I would just short Amazon if I were short consumer discretionary. But
we will never know, because they can only really name the indexes and the sectors. He might be short something.
Tesla's still down almost 40% year to date.
It's the second worst performer in that index. Anyways, coming up, we're going to go to tech. We're going to talk about Intel, though, because it's jumping after TSMC makes a pitch to operate the chip makers' factories with a bunch of partners. We're going to take a closer look next. This is Bloomberg.
Welcome back to Open Interest. We do have some breaking news from our neighbors up north. The Bank of Canada cutting its key interest rate 25 basis points to 2.75%. That had been the expectation. To bring you some details from that decision, the Bank of Canada will watch upward inflation pressure and expectations, threading a difficult needle here, though, because CPI is expected to rise 2.5% in March, and they're worried about the impact of tariffs. But at the same time, they say that they cannot offset the tariff harm. They can prevent ongoing inflation, and they warn about that economic hit that they might get. Of course, if we do see prolonged tariffs here, maybe a little preview of what we might hear from the Fed next Wednesday.
Yeah, we're getting some notes along from the Bank of Canada Governor Tiff Macklem, who says, looking ahead, the trade conflict with the United States can be expected to weigh on economic activity, while also increasing prices and inflation,
There you go.
We are also watching Intel. The stock is jumping this morning on a report that TSMC proposed to run the Intel foundry division in a joint venture with NVIDIA, AMD, and Broadcom. That's pretty big news. Here with more is Bloomberg's Jackie Davalos. So, Jackie, what do we know about the potential investment in JV?
Well, we should caveat that this is according to a Reuters report. There's been a lot of back and forth regarding what a deal could look like with TSMC and Intel. They've gotten a lot of encouragement from the Trump administration to really bring Intel out of the struggling period it has been in for years. Remember, this is the American manufacturing icon. A lot of Trump's focus has been to bring domestic manufacturing, especially for advanced chips, back here to the U.S. TSMC is a key partner because they control so much of that manufacturing, about 90% of that share worldwide. Now, this potential deal, it's not clear whether this supersedes the $100 billion commitment we heard about earlier this month. So this could be, something that was percolating before that $100 billion commitment actually came through. But what it entails is bringing in new partners, Broadcom, NVIDIA, Qualcomm, American chip makers and designers that could be part of this joint venture. But again, we don't really know if this is kind of stale, kind of coming out of the prior conversations, or if that $100 billion commitment is the key step forward.
One question I have, to your point on NVIDIA, AMD, Broadcom, I guess when I see fierce rivals being named in the same breath, I get a little skeptical that everyone wants to play nice. And so what incentive do they have to work together to get this done?
They can stay within the good graces of the administration. Right now, TSMC is a great example of where political pressure really collides with what's best for their business. They have factories here in the U.S. When you think about the other American players, they want assurances, I'm sure, from the administration. Remember, Qualcomm was one of those that actually just had a meeting on Capitol Hill with the president and his administration to discuss manufacturing, tariffs, and other policy that could affect them. So as you look at some of these players coming in here, they're going to be beneficiaries of the support that the government then extends to the AI sector.
All right, well, it'll be fascinating to see when we finally get a deal done here. But Intel shares up about 5.5%. Jackie Davalos, great to see you. Coming up, one unit at JP Morgan churning out $100 billion worth of trades, offering hedge fund-like investing on the cheap. That's next in our Wall Street Beat. This is Bloomberg. Welcome back to Open Interest. We do have some breaking news now, and that is that Russian leader Vladimir Putin will probably agree to eventual truce terms with Ukraine. But, and this is according to a person familiar with the Kremlin's thinking, he wants to make sure his own conditions are included beforehand. Russian officials didn't discuss with their U.S. counterparts the specific deal. Of course, we've been watching this back and forth, and this is the latest reporting that we have, that Putin is likely to eventually agree to a truce, but with his own terms. We will bring you more details as we have them.
Yeah, absolutely. Eventually, I think, is the operative word here. He's likely to try to drag out the timeline, is what Bloomberg's reporting shows. We're going to switch gears now. Of course, though, the peace, when it refers to Ukraine, is a critical part of what is underpinning these markets as well. We're going to switch gears and go to the Wall Street Beat, to the most read story of the day, actually, on the Bloomberg terminal. A JP Morgan quant unit has built up a $100 billion trading book. The strategic indexes business is at the forefront of the recent boom of products offering hedge fund-like investing on the cheap. Katie and I have been covering this super closely. Joining us now, Bloomberg senior editor Sam Potter. This one hit my heart because I'm a quant myself, a failed one, but a quant nonetheless. And it's interesting to see these strategies proliferate. Why is JP Morgan's becoming so popular?
But it's important to say that JP Morgan is one of a number of broker-dealers that are doing this, that are providing these services, and indeed it is one of the biggest and is at the forefront, but there are several other big names involved as well. This is something that's really taken off in the last couple of years. Essentially, you know, when we talk about hedge fund strategies, the sophistication, the complexities of them, actually some of them are quantitative in nature, and so they are rules-based. So the idea behind these is that you can take those set of rules and you can tie it up into a bank swap or into a structured note and then just sell that. It's not as sophisticated, not as flexible as the original hedge fund strategy, but it's a cheap and easy way to put on an exposure or take off an exposure. JP Morgan has, as I say, been very much at the forefront of this. And culminating now, and they've crossed $100 billion of trades.
Right. Sam, it pains me to say we only have 30 seconds left with you, but talk to us about how this fits into today's markets, the volatility that we're seeing right now.
Well, I mean, things are so unpredictable at the moment. I think that the ability to be nimble, to dip in and out of trades is very important. I think that's one of the big appeals of QIS. They are, as we say, easy to put on, easy to take off. They're also cheaper. You know, there's a lot of pressure in Wall Street these days to reduce fees, to reduce costs. It's increasingly competitive, as it always has been, but more so. And so if you can get access to something like trend following or an option selling strategy, but do it on a cut price basis, then it's pretty in demand.
Sam, thanks so much for joining us. Bloomberg Sam Potter talking to us about QIS, this. 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld.
And coming up, U.S. inflation comes in lower than forecast, and it offers some good news for the Fed and consumers after months of stalling progress.
And as the global trade war intensifies, we'll survey the impact of Trump's tariffs with John Pearson, the global CEO of logistics giant DHL Express.
Plus, a Bloomberg exclusive, famed short seller Carson Block of Muddy Waters places his biggest bets for 2025. All that and more coming up. Let's get a check on these markets. It's interesting. You take a look at the S&P 500, still in the green, but we more than have halved our gains from session highs. The S&P 500 up about 0.5%. We were as high as 1.3% higher a little bit ago, but you can see that some of that momentum stalling. Similar story in the NASDAQ 100, though it's still higher by about 1.2%, with your big tech names rallying today. A bounce back after the brutal sessions that we have had just in the past couple of weeks. Softer than expected, cooler than expected CPI will do that for you. And then the bond market has been a head scratcher all morning. You can see yields are still higher, less so, but still higher. Not quite the response you might have expected following that bit of relief that we got in CPI, but a lot is already priced into this bond market, Matt.
Yeah, very interesting move there in credit. And maybe they just don't know how to respond to tariffs. A lot of people don't. Let's ask DHL. It's releasing its 2025 Trade Atlas this morning. The report finding global trade is set for growth despite the U.S. policy shifts and retaliatory tariffs. It also says recent global uncertainty due to President Trump's tariffs could greatly impact its forecast. So maybe that's volatile too. DHL identified India, Vietnam, and Indonesia as future growth leaders. Let's talk about it all with John Pearson. He is the CEO of DHL Express Global. John, great to have you on the program today, live out of Mexico. I think it's very fitting that you talk to us from there. Have we seen a slowdown at all in global trade due to, these tariff threats?
No, I think, firstly, good morning and good morning to your viewers and listeners. Now, I think the story on global trade, it's been somewhat frenetic over the last 2 or 3 months. We haven't seen any slowdown. Companies are preparing for different situations, and logistics heads are looking at their supply chains and seeing how they can keep their things flowing quickly to drive their own levels of customer satisfaction. What I would say, and I'm here today to release the Global Trade Atlas, the headline statistics, as you showed some of them there, are extremely positive indeed. Firstly, that over the next 5 years, trade is forecasted to grow moderately faster than the last 10, and even if all the tariffs that have been suggested were put in place, we would be growing faster than the last 10. So I use that analogy of a cassette player, whether it's fast forward or just forward or play, we will not be going into rewind in this situation. I think the last thing I'd like to say to your viewers I was just talking to another channel half an hour ago, and someone said, are you a little bit the lone voice in terms of global trade? I think it's quite the opposite now. Whilst the US might appear to be retreating from global trade, everyone else is embracing it. And I think people have started to realize that whatever the problem, trade can be part of the solution. So we're very positive on globalization. We're very positive on global trade. We are in the situation where some things are unclear at the minute.
Right.
But people are still scrambling around and writing free trade agreements in the rest of the world. And maybe the last example I would give you now is that I just read that a Toyota or Honda, excuse the memory fail there, were considering moving some of their activity into the UK to ship into the US. So trade is mercurial, and trade will find a way. It takes a while to find its way, but different doors open, different doors close, and it is our job to connect people and improve lives through trade.
Trade and life will find a way. I do want to talk about whether you're seeing any scramble on the part of your customers. For example, we just got this headline while you were speaking that Canada's new reciprocal tariffs will begin at midnight tonight. So you're seeing this real on and off again moment when it comes to these tariffs. I'm wondering what that means for your customers, whether you're seeing people sort of scramble to ship quickly to get ahead of things, or what that has actually looked like from where you're sitting.
That's a great question, and I've got real-life examples of that. Not so much with steel and some of the tariffs that have been suggested over the last few days, but we take the suggestions that there will be tariffs on Europe, on the auto car makers. We're talking to our customers for the last 10 days about their requirements. Would those automotive suppliers like to take full aircraft load, full charters, full aircraft load, or half aircraft loads into the U.S. to position material in the right place to service their customers and service manufacturing and so on and so forth. It was a little bit analogous, but I won't stretch it too far, with COVID, where people were ringing us about customs information and whether aircraft were on the ground, commercial belly space was still flying. So we recognize our position to be very proximate to our customers, to be giving real life information to our customers about what they can ship, and not having people necessarily run away and change supply chains in the next day or two if that doesn't necessarily need to be the case.
John, while I absolutely hear you on this idea that trade will find a way, what is your biggest fear, given that these trade talks are still ongoing between the U.S. and many of its counterparts?
Well, I don't have too many fears in this sense because, as I said, whilst the U.S. may be retreating from trade, the rest of the world is actually looking for trade deals right now. They're going through their diaries, so to speak, their Outlook calendar, and finding partners that they can reciprocate with. Taking the whole China plus one philosophy that has started. Organizations, Chinese organizations, I would say, as well as multinationals, are diversifying their supply chains into, as the Global Trade Atlas says, Vietnam, Indonesia, Philippines, and India, to position manufacturing sites as well as distribution centers to be able to keep serving their customers. And some of those mega e-merchants that we're all familiar with shipping into the US are also considering locating secondary manufacturing and secondary distribution centers in Vietnam and other sites. So necessity is the mother of invention. And as I said before, you should never underestimate the creativity of buyers and sellers that want to do business. And that's exactly what's happening here.
I wonder, John, we saw a very brief removal of the de minimis tariff exemption. That's, goods less than $800, I think, dollars, and that's the lion's share of what is sold, for example, on a platform like eBay or Amazon. How did that shake out for DHL? We've heard from other carriers that there was a huge backlog for days. And how are you preparing for the permanent removal of that exemption?
Yeah, well, firstly, that 3 days was chaotic for the senders and the receivers of those goods. We did a pretty good job spooling up, and we were active throughout those 3 days, getting ourselves in a position where we could collect duties and taxes and get the shipment pretty much to the customer on time. Then it was repealed, and quite honestly, we don't know whether that will be put in place again in April 1, or indeed whether the threshold will be changed from 800 to 250. So our job now is to get ready with modal solutions, different break bulk solutions, which are handled differently in a customs environment coming on. Being the largest supply chain organization in the world, there is cases where some customers may move from express to supply chain or from express to global forwarding, and different ways of getting material into the US, because I can assure you a way will be found, and it's very unclear what will actually happen. And the last point I would make there is we deal with de minimis situations all over the world, and our customs organizations and our BPO organizations on the classifications of the material are very equipped with responding to that. So that was extremely short notice. It caused a massive backlog with the USPS, and then for that very reason it was repealed. And I think we just have to watch the space, whether it's April 1 or May 1, or indeed if the threshold for de minimis is actually set at a higher level than zero. And much of the average order value of those goods is in fact less than 250. So that that would make things much easier. So we're on it, we're on top of it, and as I say, I'm just delighted to be sitting here today in an example of a country that has been the sort of poster child and the flagship of driving trade. Just 50 years ago, trade was 15% of Mexico's GDP, and as we stand here today, it's 80%. So trade is a force for good, and trade relieves many of the issues that people have in society. As I say, it's part of the problem, not part of the problem.
Thank you so very much for joining us, of course, from a critical location, of course, from Mexico. That is John Pearson, DHL Express Global CEO. Now, coming up, an exclusive interview with Muddy Waters founder and CEO Carson Block about his bets for 2025. Is it fair to say, guys, that he's kind of the last short standing?
Yeah,
One of them, certainly.
It does seem like that.
Well, we'll talk to him about where he's going next. This is Bloomberg. The Robinhood Foundation is enlisting the boldest names in finance for a stock picking contest. Participants are donating $10,000 and making 2 stock picks, a long and a short, per entry. Bloomberg LP, the parent of Bloomberg Television, is working with the Robinhood Foundation on the competition. And one of the players here, Carson Block, he's the founder and CEO of Muddy Waters. Carson is currently ranked at number 20 on the leaderboard. And Carson, this game, I'm getting a kick out of it because when it started, we were in a market that was net long, and now you're looking at a lot of people starting to win more deeply off their shorts. For example, Bill Ackman short the financials. That looked smart today. Stan Druckenmiller short consumer discretionary. What about you? When you think about the ability to go short in this market, how deeply do you dive in?
Well, so for us, I mean, we do, all of our shorts are basically the subject of activist short reporting at some point. So the name that we're short for the contest anyway, and we're not actually shorted in real life anymore, but is Grifols. And that was the subject of an activist short report by Gotham City Research. And that's a company based in Spain. And it's actually pretty interesting because, you know, at this moment, obviously, there's a lot of political turmoil, and you go to Vice President J.D. Vance's dressing down of NATO ministers a few weeks ago over free speech in the EU. It's funny because with Grifols, the national regulator in Spain actually investigated the allegations by Gotham City Research and has largely corroborated them. Grifols expects to pay, though, a fine of no more than €1 million. However, the principals behind Gotham City Research are presently under criminal investigation for that report in Spain and could do up to 6 years prison time. So Grifols really does have this political overtone as well that makes it interesting.
Well, I want to talk about a stock that you don't recommend going short. I'm talking about Tesla. You spoke to Bloomberg TV about a month ago about Elon Musk and Tesla. Let's take a quick listen.
It's one thing to ask whether you bet on Elon Musk, but I would not bet against him. I wonder if I suspect he has switched views on a macro level, but especially with how he thinks about Tesla. And that would be a little bit embarrassing for him to say publicly. So yeah, maybe just banging the table about, oh, AI, and robo-taxis is how he tries to cover up that sentiment shift internally.
So, Carson, that was on February 18th. The stock is down mightily since then, down about 38% year to date. I know that Tesla has broken the hearts of many folks who have tried to go short it, but is that still the advice? Don't bet against Elon Musk?
Well, I'd say more aptly, Tesla has broken the backs of many people who've been short it. But look, I still maintain that it's really hard to bet against Elon Musk. Of course, that was awesome timing when I said that, because it's been about the best short you could find on the planet since the moment at which I said that. But, I think that's more due to market factors and technicals and political uncertainty. Look, I've long been critical, and I agree with many of the shorts over the years, that he has not been honest. I've called him publicly a liar. But also, nobody has played the public company game better than Elon Musk. Now, is he doing irreparable damage to the Tesla brand with his political involvement? I mean, maybe, but again, this guy for years and years and years has done nothing but pull rabbits out of the hat. Just when you thought like he was about to go over the edge of the cliff, he comes back. So it's just a very difficult person against whom to bet. So yeah, we're happy looking elsewhere for shorts.
What do you think about the broader Mag 7, Carson? Back in October, you said close your eyes and buy in terms of the big U.S. stocks. For a while, that was still a great bet, right? Until I guess the market hit its high, right, in last month. Now we've seen the Magnificent Seven come down. I think all of them are losers year to date, with the exception of Meta. Is it time to short these stocks, or do you think they're going to continue to have, I guess, a little bit of resilience even after the pause that refreshes maybe that we've just seen?
So the larger context of what I was saying there was, I was talking about how in the U.S., the markets are so warped by passive investing, and fundamentals matter, less and less every day. So the Mag 7 will continue to attract, because the S&P 500 index, it's really an active index, right? They always cull the herd and drop the weakest. And then the companies that are experiencing the most market cap appreciation get greater weighting. So it's also a momentum index. So momentum has sold off, but when you look at why has momentum been such a strong way to play the markets for, since really the GFC, it has to do with monetary policy, and what's been for the vast majority of time extreme stimulus, and it's also been significantly attributable to the shift from active investing to passive investing. So I don't see us going in reverse away from passive. So yeah, like 22, you had a reversal when conditions tightened and rates went up, and we're seeing political uncertainty weighing on the markets right now. But yeah, structurally, the top names in the S&P 500 are going to continue to attract flows, and most of those flows come from 401k purchasing. So if you see a situation in which unemployment climbs significantly and 401k net flows become net negative, then you have to watch out. Then all those stocks go into reverse hard, and it's hard to see where the bottom would be. But at this point in time, I don't see that.
You know, Carson, one thing that I've been watching very closely is the turn in sentiment around financial stocks. This was a hot trade at the end of last year. You made some big calls. The one against BXMT in regard to the dividend turned out to play out. Now I'm wondering how you're looking across the financials universe. Are you looking for new shorts in banks, in real estate? Where's the pain?
Well, I mean, look, we're generally not thematic. So we're only thematic when we look in the rearview mirror. So we were really early on a lot of shorting the ESG type names. I mean, so right now we're not looking in any specific sectors or even industries. In terms of commercial real estate, I don't know how much juice there is to be squeezed there, because now there is this uncertainty around rate cuts. If rates get cut enough, at some point the CRE starts to look less bad than it had been looking. So at this point, I don't really want to try to I've never wanted to try to make a rates bet, at least on the future direction of rates. So I think if you're considering CRE type shorts, you're starting to get into that land right now. So as you said, our thesis on BXMT played out. We're happy about that, but I think there's too much uncertainty going forward for us anyway.
Carson, what about elsewhere in the world of financials? One thing that there's a lot of bell ringing about is the difference between public and private marks. Yet you are starting to see more private capital type vehicles enter the public markets, private capital entering public markets. Are you looking at BDCs or other types of vehicles that might have private holdings that might not be reflecting those underlying marks?
Well, that's interesting, because I think it was maybe around 2015, 2016, BDCs were a pretty hot area for short sellers, and also prior to the financial crisis. If you remember, David Einhorn, Greenlight, famously shorted one of the big Allied Capital and wrote a book on that. So yeah, BDCs in the past have been very aggressive with their marks. From our perspective, the issue is there enough liquidity in the BDC? And so a lot of the air had come out of them at some point. It's not an area that we've looked at recently, but yeah, I think once you get a lot of capital flowing into that space, you will certainly have players who are going to be a lot more aggressive. And really, anybody who gets to make up their marks and gets compensated based on that has a built-in incentive to be really aggressive with the marks. And we've never believed, whether it's a VC fund, a private equity fund, a BDC, we've never believed that across the board these marks are genuine marks, or really, good faith expressions of the values of the underlying assets. So yeah, that could be interesting.
Yeah, well, there is plenty of capital flowing in. We know that, especially from retail now, which is a new buyer base. I do want to go around the world, and I want to talk a little bit about China. Of course, your views on China are well known, but you've seen this chorus of sell-side analysts come out and talk about China in a bullish light. You think about Citi just this week, downgrading U.S. stocks, saying to basically upgrade and buy China. I'm just wondering what you make of that in this cycle.
Well, everybody's got to sell the growth narrative, right? So, China's been this, there's so much muscle memory, for the past couple decades of selling the China growth narrative that I'm not surprised everybody's going back to that, and they're willing to forget all of the political risk that Xi Jinping presents and how he's basically zeroed out, several classes of public company shares in the past, such as for-profit education, or close to zeroed it out. Look, it's, China's a trade, it's not an investment. You date China, you don't marry China. Like, I get it if from a tactical perspective you want to allocate money there, fine. But that's the kind of place you wake up one morning and, they invaded Taiwan and maybe the U.S. is going to war over that. And, basically you don't want to be long anything China related at that point in time. So I think everybody who's rushing in headlong needs to be aware of those risks and needs to have eyes wide open. China is not marriage material.
Carson, you married Vietnam. You're, I guess, considering an engagement with India. I want to talk about your longs. You mentioned the possibility of war, which seems more likely now than it has in decades. I mean, we're seeing a war in the Eastern Theater of Europe. And Rheinmetall came out this morning and said they see defense sales surging 40% on the European spending boom that's expected. Is that, you think, one of the most important long threads for investors to pay attention to?
European defense spending?
Well, in general, war, defense spending around the world.
Absolutely. Well, look, from a defense spending perspective, that's, that one's above my pay grade. But the geopolitical risks and the risks of war, absolutely. I don't know that Russia is in a position to make further moves in Europe in the next few years. But, what we're doing with Ukraine and basically rewarding Russia, I think that leaves a lot of powder in that powder keg. Obviously, the situation with Taiwan, I don't know that we're doing anything right now to dissuade Chinese aggression against Taiwan. Iran has been, I think, beaten back nicely by the Israelis recently, but they're probably not going to go quietly into that good night. So, yeah, this is a world that has a lot of risks of real, of expansion of kinetic war. So, and valuations just generally don't seem to recognize that because risk is massively underpriced, as it has been since the GFC.
Carson, I'm devastated to say we have to leave it there. Hope to speak to you again soon. Really enjoyed this conversation. Hope to see you in studio next time, too. That is Carson Block of Muddy Waters Capital. Meanwhile, you take a look at these markets just quickly here. You can see that those gains in the S&P 500 continuing to fade, now up only 0.4%. We were looking at gains above 1% earlier, but we'll see how this shakes out. Much more coming up next. This is Bloomberg. Well, we learned this morning that inflation cooled in February, just a little bit, offering some good news for the Federal Reserve and also consumers after months of stalling progress. Meanwhile, President Trump's tariffs will test the resilience of those U.S. consumers and the broader economy. Let's discuss all of that and more with Carla Vernón. She is CEO of The Honest Company, which is a personal care brand. It's great to have you with us, Carla, and I feel like we have to start with tariffs. Talk us through your product portfolio here. We'll get to consumers, but when it comes specifically to your lineup of goods, how are you affected by what we're seeing go into place against China, against Mexico, for example?
Good morning, Katie. It's so great to be here. It's wonderful to have the chance to speak to your audience today. I am representing The Honest Company. We are a company that makes cleanly formulated and designed baby products and personal care products. So we're right in the center store of your aisles, and we have diapers and baby wipes and surface wipes and beautiful skincare for babies, but also for adults. And I'm very pleased to say that as we reported our most recent outlook, we really do feel that we have taken into account some of the dynamic nature of the economy related to tariffs in our outlook and in our plan. So at The Honest Company, we actually have a asset-light model, and we have zero debt and $75 million of cash when we close the quarter in the bank. And our diapers are made in Mexico. Our wipes are made in China. And we really do believe that as we've been planning for this time, that we've learned from a playbook we've developed over the years. So tariffs actually are not new for us at Honest. We've been really having a plan to mitigate and be agile during the changing tariffs environment over the past 2 to 3 years. So we step into this moment with a lot of experience about how to make sure that as we provide our guidance, we have a plan that we really do believe is set up to manage some of the things that we know today and the dynamism.
Carla, I want to ask about me, kind of. I'm your target market. I have 2 kids, under the age of 5, and especially the last couple of years, as the market has rallied, I've been more willing to pay top dollar for the best products for my babies. Now that we see the market kind of tanking and I'm like watching my 401k with trepidation, I'm starting to worry about paying a premium and, maybe I can go with the store brand at Costco. Are you seeing that kind of wealth effect from consumers right now?
Well, Matt, I have come to learn that you like nice things. So I do appreciate that you also consider Honest among those products that you like. Here's my perspective. What we do know about consumers like your own family is that there is an increasing incidence in childhood allergies. The reported rates of childhood allergies have nearly doubled since 1997, and the market for sensitive skin products is expected to double by 2030 to $80 billion. Those are needs that really are quite personal. I'm also a mom. My kids are teenagers. That's a whole nother stage. I'm here for you when you get to that. But when your babies are little, you will do anything to keep them healthy, well, and comfortable. And that's where our products come in. So the Honest products have something that we call the Honest Standard, and that's been true from day one. So there are 3,500 ingredients of concern that we do not allow in our Honest products. We don't formulate with them. We don't use them. And that is one of the reasons why our products are such a good fit for people with sensitive skin concerns and people who are looking for less junk in their products. When I look at the performance of our portfolio over the last year, our consumer consumption was up 8% for the year. And even as I look at the recent quarter that we reported, our consumption was up 7% for the year. And that was very well balanced on units and on price. So that was 4% growth on units, 3% growth on price, and we have not taken pricing in the recent year. So what that indicates to us is that actually our basket size is growing and people are buying larger sizes of our products. So for now, everything I can tell, our consumer steadily believes that our products are worth it and they continue to support Honest.
Carla, we're getting a question from a viewer as well, and it is in regard to China. The question about having products made in China, having products that will be in your products from China. Do you trust the ingredients?
We have very rigorous standards at Honest. So at Honest, we have our own in-house chemists, our own in-house toxicologists. And in fact, our toxicology team is so well known in the industry that they, in fact, do a lot of advising on policy related to toxicology. So our approach to the partners that we make our products with is we're very close to understanding that the materials that they use must meet that standard of 3,500 ingredients of concern that we do not allow in our products.
Carla, I want to talk a little bit about the stock price. You had a great 2024. Shares were up 90%, but it's been a pretty rough start to 2025. Shares down about 60%. I know that there's a lot of concerns on the investor front about tariffs right now. So I hear what you're saying, that you're confident in the products and you're not necessarily worried about the trade down. But it does seem that that's what markets are worried about here.
Thanks for that question, Katie. We have, over the last 2 years, so I joined Honest 2 years ago as CEO, and over the last 2 years, our top line has grown more than 20%, and our bottom line margin expansion has grown 900 basis points. So in the year that we reported, our gross margins are now up to 38% gross margins. We're very proud of that. And that in 1 year's time represented an expansion of 900 basis points of margin. When I reported our outlook, I also talked about the reasons why we feel confident in our ability to continue driving top line growth with margin expansion. And that's really related to our transformation pillars. We've got 3 growth pillars that drive our strategy overall and allow us to deliver a comprehensive model that we believe is resilient, and we've built a plan such that we feel that we can be agile. Our 3 pillars are brand maximization. That talks all about what we do to drive the top line. Margin enhancement. And so we've got a lot of activities and a very rigorous playbook of continuing to make sure we can drive margin expansion. And then the 3rd pillar is operating discipline, which is something that is really important for a small company like ours, which talks about how we do the work and how our teams collaborate in very disciplined ways, where we are constantly checking our goals and our performance measures and making sure that we are not surprised and that we're delivering the outlook we say.
Hey, Carla, what's Jessica Alba like?
Oh.
She's the
Have you
biggest
ever met
shareholder, right?
Jess?
She's your biggest shareholder?
Jess is our, thank you for asking. Honest was founded by 4 founders. We're so proud of that. 2 of our founders were diverse. Jessica is Latina, as you know, as am I. And one of our founders was Asian. So and they were millennials. So when they created this company, they really built it for the times ahead of where we're going. Jess still sits on our board. She's a board member. And for me, I consider Jess like a soul sister. We're both moms of teenagers, so we're kind of supporting each other through that. We are both dynamic women trying to trailblaze in business. So I just think the world of Jessica.
Carla, we thank you so much for joining us today. That is Carla Vernón of The Honest Company. And we're going to switch gears. We're going to talk about another area of the consumer world, the giant in the room, Walmart, because they're facing heat from China. A lot of questions around China after asking suppliers to bear the rising cost of increased U.S. tariffs. Now, Bloomberg broke the news last week that Walmart had asked Chinese suppliers to reduce their prices to offset tariff hikes. Joining us now for more, Emily Cohn, who leads Bloomberg's consumer team. Now, with Walmart sourcing roughly 60% of its products from China, explain the dynamic here on how they're being caught up in these trade disputes.
Right. So Walmart obviously gets a lot of what it sells from China. So we reported last week that Walmart has asked some of its Chinese suppliers to reduce prices to offset the cost of the tariffs. The thing to keep in mind here is that this is what Walmart does all the time with all of its suppliers all over the world. This is in their DNA. This is how Walmart keeps its prices low and competitive. And this strategy combined with their size is the reason why we think of Walmart as a place to find the lowest prices. It's what makes Walmart Walmart. So in a way, this is what Walmart does, but it also it encapsulates this contradiction that we see playing out in the real world right now. We have the White House saying that Chinese suppliers will eat the cost of the tariffs, but then we have in these reports now these suppliers saying we really can eat these costs. Our margins are already so thin, and we just can't do it.
Yeah, so a good concrete example of that debate playing out. And as you mentioned, I mean, this is what Walmart does. Really helpful context there. But just talk us through how high the stakes are. I'm taking a look at our reporting that Walmart sources about 60% of its products from China. That exposure is pretty high.
Yeah, and I think that's why we see a lot of CEOs now coming out and saying, like, if these tariffs come into effect, which in China they already have, we are going to have to raise prices. I think there are suppliers in that story that say we can't go anything more than 2 or 3% because those are our margins, and at that point we would just be losing money.
All right, Emily, great reporting there on, of course, that Chinese authorities met with Walmart executives. That is Emily Cohn, who helps lead our retail coverage. Meanwhile, a quick check of these markets. We've been talking about these markets losing steam, and that continues and continues. The S&P 500 up just about 0.2%. We were a full percentage point higher about an hour or so below. Yeah, you can see that ouching coming through. Also,
I love the way
NASDAQ
Terrell Holt,
100.
so one of our producers says stocks coughing up gains.
Yeah, that's a word.
I've never heard it put that way, but I love that
it's just
expression.
coming right out of the body. It's just that we're losing a lot of steam.
Hopefully
here.
it doesn't
Expelling
turn
those gains.
into stocks puking, because that's what we've seen over at least yesterday. We open higher, good pre-market gain, and then it goes away. There's still a lot of daylight between now and 4 p.m., but you're also seeing it play out with the big tech stocks, which have been sort of the pain point of these markets. We'll continue to follow these moves, and coming up next this week marks 5 years since most of the world went into lockdown. In today's Wall Street Week, we'll take a look at how COVID-19 impacted the U.S. economy and the healthcare system. This is Bloomberg. All right, it's time now for our Wall Street Week conversation. And 5 years ago this week, the world as we knew it changed. COVID-19 led to lockdowns, empty businesses, and economic turmoil. David Westin spoke to Dr. Charity Dean about how the pandemic changed the U.S. healthcare system.
You know, I always say trust is the currency of public health, and right now it's bankrupt.
Healthcare was where we all were focused in the spring of 2020. Dr. Charity Dean is now CEO and co-founder of the Public Health Company. But in 2020, she was the assistant director of the California Department of Public Health. She was one of the very first to see COVID-19 for what it was and could become, and became a major figure in the Michael Lewis book, The Premonition, A Pandemic Story.
The COVID response was a massive systems failure on every level, across national security, across civilian public health, across the great American companies that hold up our economy. We did not actually have the capabilities to respond to it. And my view of that gets clearer and clearer 5 years later as I understand just how deep that devastation was. I still believe that the gift of COVID is it exposed the problems so that we Americans could do what we do best, and that is innovate solutions. I think Americans learned a tough lesson. That is, no one's coming to save you.
A 2023 Gallup poll found that Americans' trust in the medical system fell in the years following COVID, from 44% in 2021 to 34% 2 years later.
The tension between civil liberties and providing for the common defense of Americans is the oldest tension in public health. It's as old as our country. Ever since there were vaccines, there's been the argument over vaccine mandates. I am not afraid of that debate because it's the right debate to have, protecting individuals' right to choose versus protecting the whole. I massively support vaccine requirements for kiddos entering public schools. Why? Because the kids that are vulnerable, they have a right to an education that is safe. They have a right to attend school and not worried they're going to get infected by measles because someone else wasn't vaccinated. Having said that, Americans questioning a vaccine mandate during COVID, I think that's just very American. It's who we are. At our core, we're rebels, fighting for our freedom, fighting for our individual liberty. It's what founded this country. So I'm not afraid of that discussion. And I understand American parents who are hesitant, who have lost faith in public health. All of my kids are vaccinated, and so am I. You know, the question of employer vaccine mandates or military vaccine, I will leave that to those more qualified to answer those questions, Secretary Hegseth and others who are running those departments. But I'm not surprised that that became a question in Americans' minds because it's the right debate to have.
And that was David Westin on the pandemic's effect on healthcare. You can catch Wall Street Week every Friday at 6 p.m. Eastern. Now coming up, Trump puts Teslas on the White House lawn as the stock takes a bumpy ride. More next. This is Bloomberg.
called him publicly a liar, but also nobody has played the public company game better than Elon Musk. Now, is he doing irreparable damage to the Tesla brand with his political involvement? I mean, maybe, but again, this guy for years and years and years has done nothing but pull rabbits out of the hat. Just when you thought like he was about to go over the edge of the cliff, he comes back. So it's just a very difficult person against whom to bet.
That was Muddy Waters CEO Carson Block speaking to us earlier. It's been a rough few weeks, though, for Tesla's stock. And even Elon Musk's biggest fans are backing away from it as it continues to nosedive. The CEO of Tesla and the head of the Department of Government Efficiency did get an endorsement, though, from one fan, President Trump. He said he would buy a Tesla to keep at the White House for the use of his staff. It's a beautiful red Model S, and it's all computer. For more on the story, let's bring in Bloomberg Businessweek's Max Chafkin. We laugh a little because that was an incredible piece of showmanship yesterday.
Everything's computer.
On the president's behalf, on Elon Musk's behalf, a little infomercial for the Tesla. Does that help? Because he clearly has been driving away buyers. In Germany, for instance, registrations fell 70% in the first 2 months.
Yeah. Well, look, whatever you think about Trump politically, whether you agree with him or not, I think most people do agree that the man can put on a show, and that is what we saw. We saw, basically like an episode of The Apprentice, ending with Trump, literally picking out Tesla. In some ways, of course, that's great news for Elon Musk. You have a guy with a, very large media platform. These clips were shown, over and over again on the news. People are watching them. It's the best kind of media you could ask for. On the other hand, not clear to me that Musk is getting a lot of new customers here, right? Musk is so deep in with Donald Trump. I'm not sure that the hardcore Trump supporters really needed to hear this, although it does, I think, make Elon Musk feel better, make him feel like, yes, the protests that I'm enduring, the sales declines that Tesla has gone through, maybe they're worth all the work I'm putting in. Mm-hmm. And I think that was at least part of it. Trump was trying to, do his advisor and friend now and financial backer a solid.
Can you put truck nuts on a Tesla?
I have no way to answer that. I do not know. I do want to bring this conversation to the stock price. We were talking to Steph Guild from Robinhood at the top of the 9 a.m. She said on the Robinhood platform, people and retail traders are buying the dip in Tesla stock, but then you hear from the likes of Carson Block of Muddy Waters saying that maybe Trump is, or not Trump, Elon Musk is doing permanent damage to the Tesla brand, and the stock is down 40% year to date still.
Yeah, we should say the stock is up a bit this morning, but it's still below where it was, before the election. Musk has not, for all this proximity to power, for all the ways, and there are lots of ways we could talk about that he could benefit from this transaction. He has not benefited so far, and I think it's pretty clear, at least to date, that Trump is getting kind of the better end of this transaction, which of course that's the kind of thing that Trump is famous for. Tesla's main customer base were liberals, progressives, middle-class people in cities. It's the kind of person who would either be kind of like a moderate Republican or a Kamala Harris, Joe Biden type voter, and Musk has effectively been turning his back on that constituency, and that's why you're seeing not just these protests, but people sticking bumper stickers on their Teslas that say, I bought this before he went crazy. Or even, in extreme cases, Tesla owners buying badges from other car makes so they can hide their affiliation. And I think it's going to be very hard, just as Carson Block is saying, to undo some of this damage. The problem is Trump does have a big following. There are a lot of enthusiastic Trump voters. They are not necessarily ideal Tesla customers. The Cybertruck has not done super well. When you look at the reviews, some people really like the design, but it kind of appeals not to a person who owns a working truck, but sort of like a wealthy person who's looking to show off. And a lot of truck buyers, they need very specific things that are not necessarily in that truck. Right. And you're seeing a company that has sort of a stale lineup, but a bunch of issues that go beyond branding as well.
I just want to point out, Biden did something similar for the Ford F-150, right? He went to Detroit for a pool of media, drove around the Lightning, said what a great truck it was and how fast it was, and Elon Musk was one of these liberal corporatists before President Biden, pushed him towards the oligarch camp.
Well, so the interesting thing here is this was like a perfect mirror image to this event in August of 2021 when Biden, you brought up the F-150 event. Biden had an event at the South Lawn of the White House, same location roughly as this one, where he praised GM and Ford for their electric car contributions. Musk, really, that was kind of the turning point.
That was the snub heard around the world,
That was
right?
the snub heard around the world. Now, the interesting thing is, Musk yesterday is talking about, oh, it's like night and day. He's really enjoying this. A lot of his fans really see, like, okay, this is why I supported Trump. We're finally getting the respect we deserve. Look at the stock price during that period. Tesla's stock was worth a lot more during the Biden years than the Trump years. And I think part of the reason, part of that had to do with COVID and, there are issues that have nothing to do with products or policy.
Right.
But
Max,
Tesla was doing well.
unfortunately,
Yeah,
we got to go. We got 10 seconds left. That is Max Chafkin. So fascinating. We'll continue to talk to Max and all things Tesla. We have to end it there. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Shonali Basak.
And I'm Jackie Duvall in Washington. This is Bloomberg Technology. Coming up, stocks rebound after a positive inflation reading. The relief comes after some market turmoil this week on the back of President Trump's tariffs. Plus, we'll dive into what's behind the retreat from Musk's EV company, with Tesla being the biggest decliner in the S&P 500 index this year. And SpaceX's Crew 10 is launching this evening for a relief mission for NASA astronauts at the International Space Station. But first, let's get a check on those markets. Shonali?
Yeah, absolutely. First, I want to bring you into the NASDAQ 100 here, Jackie, because we did start the day strong. We are losing some of that steam today, and looking at a NASDAQ 100, currently up only about 0.4%. Remember, we've had a lot of malaise in recent days. Let's flip up the board here. Also take a quick look at the Philadelphia Semiconductor Index, because that has been harder hit this year. Yet you are seeing a little bit of a bigger gain there in the index, up almost 2% today. And part of that, of course, is because of Intel. Intel still up about 2.6%. Again, not as much as it was up earlier in the day, but still up off the heels of a report from Reuters saying that, of course, partners are being formed around the foundry business, potential joint ventures led by TSMC, potentially AMD, NVIDIA as well, and Broadcom. But of course, Intel now snapping, Jackie, 7 days of losses.
Let's get into some of these Intel moves right away with Bloomberg's Mike Shepard. Mike, there's still a lot we don't know about some of this report coming from Reuters on Intel. Fill us in on what we do know.
Well, one of the questions is really how much of this would ultimately bear fruit. And we had reported about a month ago now that the Trump administration had approached TSMC to perhaps take over Intel's foundry business. That would be a big undertaking, of course, given all the malaise surrounding Intel and some of the business complications therein. But it also opened the door to perhaps working together with other companies. And this report would certainly fit into that. However, more recent events suggest a different direction of travel. Intel announced this $100 billion additional investment in the U.S. A little more than a week ago with President Donald Trump. And that's the kind of thing that doesn't seem to include or leave room for Intel. Also, there are some thorny problems involved here. One of them is intellectual property. Would TSMC be willing to share some of its precious trade secrets with a company that could in other ways also be a rival when it comes to its business? Likewise, integrating some of Intel's operations into TSMC would also involve a lot of work. So there's a lot of skepticism surrounding this report. We'll have to see what actually develops.
Mike, I want to bring in your broader view here, of course, because you're seeing a market today that is reacting to some of the relief relative to where we were 24 hours ago in the tariff story. Yet you are seeing retaliatory tariffs coming in from around the world, looking at the EU and Canada. How are investors, markets digesting the latest coming out of Washington, and what is still absolutely uncertain?
Well, there is a lot of uncertainty. As you put it earlier in the intro, malaise, that really seems to be one of the operative words right now when it comes to investors, and especially in the tech sector. When you look at the NASDAQ 100, it really has taken the brunt of this downdraft in markets. Obviously, there was a lot of run-up ahead of time in the past year or so on enthusiasm about artificial intelligence. And, you know, what goes up is now coming down. But a lot of that is being fueled by uncertainty surrounding the president's tariff policies. And last night, during a meeting with top CEOs here in Washington, he signaled that they should be prepared for more. He sees tariffs as a tool for getting companies to invest in the U.S. And he has cited in the past Apple's decision to invest $500 billion here in the U.S. And we just talked about TSMC's plans. Both of those he credited to his own tariff policies.
Let's talk a little bit more about that meeting. There was a lot of anticipation. We saw chip stocks really take a beating last week, but now they're getting a little bit of relief. They're up by about 1.6%. What did we learn more from that meeting with tech CEOs earlier?
Well, the tech CEOs meeting on Monday seemed to be less of a fireworks event, and then the business roundtable meeting last night seemed to be a little bit more of a more cordial give and take, you know, even given the circumstances that we're seeing in the market and the concerns that CEOs may have about where to take their business in light of the way tariffs could affect their supply chains. We heard Anthony Neri, the CEO of Hewlett-Packard Enterprises, tell investors on a call last week, look, we don't know where this is going exactly. There may be some pricing changes. We're going to do the best we can through our supply chain to minimize the impact, but they really don't know where it's going. And that was also echoed by the head of Broadcom, Hock Tan, on a call with investors as well, suggesting that, hey, this is really early and we don't know where this is going.
Mike, we appreciate all your time and all your analysis. That is Bloomberg's Mike Shepard. Now, I quickly want to check in on shares of Tesla as well, because as Mike was talking about, a lot of malaise in the tech sector, but not today. And Tesla is the one that's really leading the NASDAQ 100 higher. It is still up more than 5%. But remember, it was down 15% on Monday. So between Tuesday and Wednesday's gain, we have not recouped all of those losses. Yet it sure helps that it's up today for the broader NASDAQ 100. And to zoom out now, we're going to bring in Amanda Agati. She is the CIO of PNC Asset Management Group. You know, you think about what's happening in the tech sector. Yes, today is a day of relief, but the Mag 7, the relative underperformance that you have seen, at what point do you see that overhang start to disappear? Really, the only member of the Mag 7 that is up year to date is Meta.
That's right. It's great to be with you, and I would say that overhang is going to stick around for a while here. The challenge is that we're still very much in a purple haze of fiscal policy uncertainty, and it's namely tariff and trade-related policy. And so it's not so much of a direct hit to the underlying fundamentals of the Mag 7. In fact, I think for the most part, their business models tend to be somewhat insulated from it. But the challenge is that in this purple haze of uncertainty, there's pretty extreme valuation multiple compression. And the Mag 7 have been priced to near perfection. So we're not seeing fundamentals deteriorate. We're just seeing multiples come down materially until we start to get past some of this growth scare narrative that's been gripping markets. I think it's going to continue to be an overhang.
Amanda, you mentioned fundamentals. They look strong. There was so much reassurance from companies and appeased investors that a lot of the CapEx going in isn't going to stop. That spigot is going to keep going. But are we bracing for a more fragile tech sector now? What catalysts going forward do you see kind of providing more assurance to investors that they're not going to be that easy to break?
It's a really great question, and it's a really hard one to answer. And I think that's why tech investors in particular are struggling in this environment, because we are craving more catalysts. We're in a little bit of a lull in terms of innovation. And so the focus these last few years has really been on chips. One stock in particular. But where are all these use cases? We need to see broader based use cases, new business models really developing and broadening in terms of adoption across the market. I think that's really the critical catalyst or next step to this next wave of innovation, and perhaps even getting the market rally catalyzed again. So I think it's going to take a little bit of time given some of this policy uncertainty, but I think it absolutely could become a tailwind in the second half of this year and into 2026. It's just we're in a little bit of a void at the moment, which is very frustrating, certainly.
Now, you know, one interesting part of the tech trade as well is just how much it has contributed to the weakness in the consumer discretionary sector. For the S&P 500, you think about Amazon, you think about Tesla. In reality, how levered are some of those giant tech names to the U.S. consumer and any potential further weakening?
Well, I always say that the U.S. consumers in the driver's seat, right? 70% of GDP or, you know, spending in this consumption is tied to the consumer in some way, shape, or form. And so the path for the consumer and the health of the U.S. consumer is critical for all of us in terms of both the market and the economic cycle. But I think you're right to make a little bit of a distinction here in terms of how much influence directly hits some of those business models. I think the story and the concern is much much more around, do consumers start to get a bit more paralyzed by this policy uncertainty, and so they slow down or even stop spending, which sort of cascades into a more material slowdown than what we're seeing. The earnings growth backdrop is continuing to be strong. It's not so much about one quarter. The full year expectation still looks very strong. The economic cycle looks pretty strong. Consumer spending related data looks solid. So again, it's all about this sort of narrative and this sentiment concern. It's not so much translating into the underlying fundamentals breaking down yet.
Now, when you think about the consumer also, we're thinking about the U.S. consumer so much, and you have to wonder whether Europe, China is a bigger headwind or tailwind for this group. Do you see any risk there?
I'm most concerned, I think, about developed international exposure, and so Europe in particular, just given some of the continued geopolitical tensions and conflict. You know, are we going to get a resolution out of Russia and Ukraine or not? That's a really critical thing that I think needs to happen to see signs of life improve in a more material way across the Eurozone. I think it is possible to see a bit of a relief rally. We started to get it at the beginning of the year, and then we've seemingly seen it falter a bit here. So, you know, I am most concerned about that area. I think in terms of emerging markets more broadly, there's a really attractive valuation opportunity there. So for investors who can be patient, I think this is a very attractive entry point, even in the midst of, you know, additional tariff policy aimed specifically at China. I think there is a real opportunity set there for investors to be focused on in terms of allocating capital early this year.
Amanda, on that emerging market story, China is a huge competitor here in the tech space. Are you seeing any interesting opportunities with some of those up-and-coming companies unveiling new features and AI models every week that could give investors perhaps another choice outside of the traditional US-based tech players?
Well, I'm never going to bet against our U.S. Tech industry. Just as a general rule, I have a very home country bias here. But of course, I mean, I think innovation shows up in all different shapes and forms. And so, you know, even just what seemingly is old news now, but the DeepSeek story that sort of came out of nowhere recently, I think is fascinating in terms of this innovation story being born out of anywhere and sort of this natural comparative or competitive advantage that we have as it relates to AI, automation, robotics, et cetera. The story continues. And so I think it's really healthy. And I think it's important for investors to think much bigger and more holistically than just, you know, one or two names. This cycle is very early innings. We have a long, long runway here. And so we are absolutely believers in the secular tailwinds here. And so from a multi-asset investor perspective, I think you really do have to look beyond U.S. equities in this environment. Even in private markets, I think there's a tremendous amount of opportunity in VC land.
We'll have you down as not betting against the U.S. Amanda Agati from PNC Asset Management, thank you so much for joining us. Coming up, Google DeepMind launches a new branch of its AI model to help robots navigate the physical world. We'll get the details after the break. This is Bloomberg. Google DeepMind has unveiled a new Gemini model that it says helps robots understand the physical world around them. Bloomberg's Mark Gurman joins us now. Mark, it seems like every big tech company has been unveiling some kind of new robotics venture as of late. How does Google stack up?
Yeah, I've been trying to tell everyone on here, robotics, consumer robotics is the next big thing in the industry, right? We had autonomous cars, we had mixed reality, AR glasses, we have voice, right? But artificial intelligence is going to be at the core of everything. And really the ultimate hardware expression of AI is robotics, right? Being able to understand how a human acts, right? Artificially learn from data, right? And mimic a human. And that is what a robot is, right? And so you've seen Tesla play in this space. Now you're seeing Meta make a big investment in that space. And now today, Google is announcing new Gemini models and infrastructure specific to powering robots. So all of these companies want to play in this space. Meta announced versions of Llama, right, in a big investment to build consumer robots and to be at the center of everything. Meta wants to be the future operating system to power these robots, but they're going to have a big competitor here with Google, right, who has experience building operating systems for first-party and third-party hardware. And obviously, Gemini is right up there with Llama and ChatGPT and the other AI systems. So this is a big deal not only for Google, but the industry at large.
So, Mark, how convincing is this push? Because we have seen Google try, or Alphabet try, to get into the robot world before. My understanding is that they shut down a spin-off company that was associated with this. So this time around, what's the difference and how big is the push?
I think the difference this time is Gemini, right? The underlying AI technology is much different. It's much more advanced. It's more reputable, right? And now appears to be the time where companies are willing to put in the proper investment, the necessary infrastructure to make robotics happen, right? Waymo has been pretty successful comparatively in the industry. And so what you're seeing is a lot of data collection there, a lot of experience in autonomy and cameras, and that's technology that Google could ultimately use if it wanted to build its own humanoid. But don't count out Apple. Apple has skunkworks teams working on humanoid robots as well. The big difference is they're not going to publicly release an underlying robotic model, right, in order to support third-party robots and other consumer hardware. They're going to go all in-house. They're going to follow the Tesla method that you've seen from the Tesla bot over the past couple of years. So at some point in the next 5 to 10 years, you're going to see real competition between Google, Meta, Apple, Tesla, the Chinese companies, and others in consumer robots. So stay tuned. This is going to be a really big deal. And some of those movies we've seen over the last several decades, they're starting to come to reality.
Mark, we thank you so much for your time today, breaking it all down for us. That is Bloomberg's Mark Gurman, and as you know, I'm excited about having a robot at home, and we're going to talk more about robots here. Not as pleasant of a story. Shares of consumer robotics company iRobot, they're sliding today after it warned of, quote, substantial doubt over its ability to continue to operate. You might remember that the company was once sought after by Amazon for more than $1 billion, and it has begun a formal strategic review to evaluate options. For more, Bloomberg's Irene Garcia Perez joins us now on set. Was this warning a surprise, especially given the kind of unicorn standing that it once had?
Not totally. The company has been losing money and burning cash for the past at least 3 years. And then when the Amazon deal failed, basically last year, the company lost a big option. It started a strategic review last year. It has cut losses, but it's still loss-making, and it has cut expenses, but it's still struggling.
Irene, what does this tell us about the state of consumer demand in this space? As we were hearing, it seems like the time horizon for some of these technologies to really get in the hands of consumers takes time, especially for those to get used to them. What does this tell us?
So in the case of this company, I guess it's another example of consumers cutting on discretionary spending. We've seen it in other names like casual dining companies like Hooters considering bankruptcy filing. We've seen it in a broad range of retailers also struggling. So this is another example. And the company mentioned in the going concern warning that consumer spending could be one of the reasons why, like weaker consumer spending could be one of the reasons why it doesn't manage to survive. And tariffs was another one that they mentioned as a potential threat to the company's viability.
Tariffs weighing in here as well. Bloomberg's Irene Garcia Perez, thank you so much for joining us. Still coming up, Tesla investors may be sitting on the sidelines as shares of Tesla fall over 42% so far this year. More on that next. This is Bloomberg.
Now, some long-term Tesla investors are backing away from the stock after falling as much as 42% so far this year. And this is as questions arise about the company's future. For more, Bloomberg's Max Chafkin joins us today. Now, I want to point out also, of course, today people are buying the dip. People are believing the story today. You have the president himself looking to defend Musk in many ways. What is the trouble in paradise?
I mean, more than defend, holding a sales event on the White House lawn. The trouble is that Tesla's customer base is not especially Trumpy, and that's probably an understatement. You think of a typical Tesla owner, this is like an upper middle class, suburban, progressive, or at least a centrist, somebody who cares about the environment. These are not Trump voters. These are very much the constituency that backed Barack Obama, Joe Biden, and to a large extent Kamala Harris. And those people, which include a lot of Tesla customers, are very mad at Elon Musk right now. We've seen protests all across the country and the world, including some, acts of vandalism, and just this kind of tone of mockery of seeing Elon Musk as kind of a lightning rod for the worst, for what these Tesla customers see as the worst excesses of the Trump administration so far.
Max, and it's not just about the political leanings of who's buying some of those cars, but they've recently gotten some pretty good support, especially under the Biden administration, for EV credits. And I'm having trouble reconciling how Elon Musk can really back Trump in some ways, but his company is somewhat dependent on the government also supporting the transition to electric vehicles. How is that working out?
Yeah, you know, Trump kind of ran to some extent as an opponent of electric vehicles, talking constantly about ending the quote-unquote electric vehicle mandate. You know, and in fact signed an executive order early on stating an intention to pull back some of these regulations. Even brought this up during the event yesterday, offering it as an example of how selfless Musk is. I think from the kind of bull perspective, like why Tesla investors could be potentially okay with this, is the fact that Tesla has a leading market position. So if you remove these subsidies from electric cars, it arguably hurts GM and Ford and Tesla's other competitors more than it hurts Tesla. Tesla has wider margins on EVs. It's able to better absorb this. Now, that said, those companies are bringing out new models and they're stealing customers away from Tesla.
Right. That's Bloomberg's Max Chafkin. Thanks so much for joining us. Still coming up, another NASA SpaceX mission to set launch later today. It's hoping to bring back 2 NASA astronauts stuck there since June. This is Bloomberg.
And welcome back to Bloomberg Technology. I'm Shonali Bassick in New York.
And I'm Jackie Davalos in Washington.
Let's get a check on these markets because you do have a NASDAQ 100 that has been fluctuating. We are well off of session lows for the morning, but only up now about 0.6%, and it's trying to fight for dominance. You have the NASDAQ 100 with only roughly half of its component parts up on the day. The other half, of course, down. The Philadelphia Semiconductor Index maintaining its lead after a brutal stretch the last couple of weeks. It is now up about 2.3% heading into midday. And for a check on other movers this morning, we're going to bring in Bloomberg's Isabel Lee, who joins us now on set.
Hey, Shonali. So there's really a ton of uncertainty in the markets right now. A gauge by Citi shifted from risk on to risk off, rather, in just 6 weeks. And really just a slew of headlines crossing the wire this morning, from Canada firing back on tariffs to inflation, is really causing some more angst. So back to inflation, that's a big data today. It showed some signs of easing, but even so, economists are anticipating that the escalating trade war will really just drive up prices. And you see waves of selling, even in tech high flyers. So Tesla, Supermicro, and Palantir, for instance, have wiped out more than a quarter of their value in the last 14 trading sessions since they peaked. So their losses are more than triple the decline of the S&P. So really a tough market right now. And of course, the NASDAQ 100 tumbled into correction territory last week.
Isabel, talk to us about what we're seeing in some of those Mag 7 names. You mentioned Tesla seeing some relief. What else are we seeing when it comes to the big tech giants that absolutely got battered earlier this week?
They're still really battered. Tesla is leading the losses in the Magnificent 7 index, and you see the rally broadening out, and there are the losers right now. In fact, a note earlier this morning says Maleficent 7, and you see that people are now questioning whether the U.S. exceptionalism has cracks. We have Citigroup and HSBC downgrading their views on U.S. equities this week. I talked to a bank yesterday, and they said that they're underweight the Magnificent 7, which is really a stark contrast to when everyone was just piling in, because if you don't pile in, then you underperform the benchmark. But we have JP Morgan, David Lebowitz, which I talked to yesterday, said that, risk premiums have jumped, credit market has yet to crack. Economic data, at least for now, points to expansion, so bullish overall in the long term.
That's Bloomberg's Isabel Lee. Thank you so much for joining us. 2 astronauts stranded at the International Space Station since arriving aboard Boeing's Starliner in June could finally be heading home. That's part of the goal for the SpaceX Crew 10 mission scheduled to launch later today. Joining us to talk about this is Clayton Swope. He's Deputy Director of the Aerospace Security Project and a Senior Fellow at the Center for Strategic and International Studies. Clayton, this is a really big moment. Everyone has really become so endeared to Sonny and Butch. What did this tell us about what went wrong, and will this ever happen again?
Well, Jackie, it's funny. I was thinking, too, the one thing that I have as a takeaway is just it's about Sonny and Butch and just their endurance and their patience and their grace. And it's something that I think back on. I think I admire that. I'm sure a lot of Americans admire that, and people around the world. And probably you, like me, I get upset when I'm 3 hours delayed at the airport and they've been there since June. So it's a very different thing to think how long that they've been up there and everything that they've been through. But they've had that poise throughout. I think what we've learned, too, is that space really can still throw us curveballs, but that we have gotten to the point where we have flexibility and adaptability, that we can still do human space flight safely and do that at scale. And that's a lot of credit to NASA on the approach that they've taken to get us here, and then also to SpaceX, on whose technology we really relied on to make this happen.
How do you think about the next steps moving forward when it comes to the Starliner? What do you think is the future from here?
Well, there's still a lot of things that we don't know. We do know that Boeing has said they want to stay in the space game. It's less clear on what happens next for Starliner specifically. That will depend a lot on what NASA decides with Boeing about certifying that capsule to fly astronauts again into space. So we don't really know how long that would take. But if we look to the horizon, just with the International Space Station, we're planning for it to deorbit in 2030. So that's less than 5 years away. So there's really only a few more opportunities, really, in the grand scheme to bring astronauts to that station, and that window is quickly closing.
There's been a lot going on in the space field as of late, and I think it has many people wondering, are we in a new space race of some kind? How does the U.S. stack up with what we're doing in the field versus other countries?
It's really hard to not think about China and all their achievements in space. Right now, there's 7 astronauts and cosmonauts on the International Space Station.
Hold that thought for a moment here, because we want to bring our audience some live images of President Trump, who is greeting the Prime Minister of Ireland. The two men are about to take part in a bilateral meeting at the Oval Office. Now, we will bring you those headlines as they come in. You could also check for updates on Live Go on your Bloomberg terminal. Now, Jackie, back to you.
Talk to us more about how China is really getting to the space race.
Yeah, there's 3 Chinese astronauts on their space station, Tiangong 3, right now, as we speak. So they've really made space look routine in a lot of ways that America has also been able to do. They're also eyeing the moon. They want to land Chinese astronauts on the moon by 2030. So is NASA. I think it's hard to avoid the notion that this is a space race, maybe a moon race 2.0. The United States is still the undeniable space power, lead space power in the world, but China is definitely nipping at our heels.
Let's talk about who's making us the space power. We hear a lot about SpaceX, but over in Silicon Valley, there's a lot of contenders really coming into the fore as well. What are you seeing in terms of concentration of who's taking us to the next level?
SpaceX is the main player right now when it comes to launch, when it comes to broadband from low Earth orbit, when it comes to a lot of the things that we rely on to get people and cargo to the space station. But there are a lot of other companies that are innovating in Silicon Valley and around the country. You have companies in Pittsburgh and Texas and Florida. They're trying to catch up and come up with new ways to do space, to do it cheaper, to do it more efficiently, to mine asteroids even. So there are a lot of up-and-comers that really will challenge SpaceX's dominance, and it will be their game to lose, though, over time, because there's a lot of smart people, though, right behind them.
Let's talk a little bit about who's behind SpaceX, because Elon Musk has been making waves here in Washington for other reasons. But one of the areas that he's poised to potentially benefit from are his relationships in Washington, SpaceX potentially getting more contracts. Does his politics detract in any way from the progress that SpaceX can make, or does it really operate independently of that?
SpaceX has led the way for what we call commercial space today, and it has taken a number of years for them to get to where they are. This isn't something that just happened with President Trump's inauguration in January. This has been a long trend where NASA, the Department of Defense, and other customers, both commercially and internationally, have really grown to depend on SpaceX for launch. And